It's 11:30 on a Tuesday night. You're lying in bed scrolling through financial YouTube and you've just watched your third video explaining why the portfolio you built last month is already wrong. One creator says buy the S&P 500 and nothing else. Another says technology is the only path to real wealth. A third insists you're actively losing money by holding international stocks. If you take all of them seriously, your portfolio changes every single week. You end up believing there's always a better fund, always a cheaper ETF, always a cleaner strategy than the one you're currently holding. I spent years doing exactly that, reading, comparing, watching videos, obsessing over basis points, and after all of it, I made a decision that probably sounds like I gave up. I moved my money into a target date fund. I want to explain why, because I don't think it's what most people assume. I didn't do it because I stopped caring about returns. I didn't do it because I couldn't figure out how to build a portfolio. I did it because I eventually noticed something that took me an embarrassingly long time to see. The hours I was spending on this were not making me richer, they were just making me more anxious. And once I admitted that, a lot of things I thought I understood about investing started to look different. When I first started investing, I wanted what most beginners want, the perfect portfolio. Not just a good one, a perfect one. I spent hours comparing expense ratios down to the 100th%. I read white papers on small cap value. I learned what tracking error was. I studied factor tilts. Every morning my feed had a new question I hadn't thought about before. Should I hold 100% equities or keep some bonds? Should I overweight large cap growth? Do I need a slice of emerging markets, or is the drag not worth it? Should I reduce international exposure because the US has been dominating for 15 years? The financial industry runs on this kind of thinking. There's always a new variable to consider, always a refinement to make, always a niche ETF that unlocks some premium you've been missing. And the frustrating part is that a lot of the arguments are genuinely logical. You can make a reasonable case for dozens of different portfolios. The problem is they can't all be right simultaneously, and nobody in the comment section actually knows which one will win the next decade. Eventually, I started doing the math on my own behavior rather than my expense ratios. I was spending hundreds of hours a year managing a portfolio that was already perfectly fine. I was checking my balances every day. I was treating a retirement account like it required daily maintenance. I was suffering from what I can only describe as optimization FOMO, the fear that somewhere out there was a fractionally better version of my portfolio and I just hadn't found it yet. The stress wasn't producing better returns. I was generating anxiety about small differences that, over 30 years, would barely move the needle. So I looked more carefully at what a target date fund actually is, because I dismissed them for years as something for people who don't know what they're doing. When you open up a Vanguard Target Retirement Fund and look at what's inside, it's not one vague pooled investment. It holds 4 underlying index funds: total U.S. stock market, total international stock market, total U.S. bonds, and total international bonds. That combination gives you ownership of large American companies like Microsoft and Apple, mid-sized businesses in Ohio, small-cap stocks in Japan, and government bonds in Germany. Thousands of companies and bonds spanning the entire world inside a single fund. To hold all of that yourself, you'd buy those 4 ETFs separately. Decide your allocation between them, monitor whether your percentages have drifted over time, and manually rebalance when they have. The target date fund just handles all of that automatically. It sounds almost too simple. But the simplicity is not an accident, it's the whole point. There's no friction, no maintenance, nothing to log in and manage. You make your monthly contributions and the portfolio does the rest. The obvious objection is the cost, and it's a real one. Critics correctly point out that you can build the exact same portfolio yourself using individual ETFs and pay less. Here's what that actually looks like. A Vanguard Target Retirement Fund has an expense ratio of around 0.08%. Building the same portfolio yourself with individual Vanguard ETFs, VTI for US stocks, VXUS for international, BND for US bonds, BNDX for international bonds, gets you down to roughly 0.04% to 0.05% depending on your exact allocation. On a $100,000 portfolio, that's the difference between paying $80 a year and paying $40 a year. You save $40. On $500,000, the annual savings is $200. On $1 million, it's $400. I spent a while turning that number over in my head. $40 per 100,000. And then I started thinking about what mistakes actually cost. Delaying a contribution because the market looks expensive. Shifting your allocation after a bad month because a convincing YouTube video made you nervous. Selling during a downturn because the drawdown got large enough that it stopped feeling temporary. Any one of those decisions costs more than $40. Most of them cost thousands. The fee difference between doing it yourself and using a target date fund is real, but it's small enough that a single bad decision wipes it out immediately and then some. So the real question isn't whether you're capable of building the 4-fund portfolio, it's whether you're capable of maintaining it, without interference, through 30 years of market noise. The loudest criticism of target date funds is always the international allocation. Most of them put roughly 36% to 40% of the equity portion into international stocks, which has been a frustrating position to hold for anyone who started investing in the last 15 years. From 2010 through 2024, U.S. stocks outperformed international stocks by something like 500 percentage points. The S&P 500 ran. International markets mostly didn't. The Magnificent Seven, the giant U.S. tech companies, drove returns that international markets simply couldn't match. So a lot of investors have concluded that global diversification is just dead weight, and they've gone 100% U.S. equities. The problem with that logic is that it starts at the finish line. Go back further and the picture looks different. Through the 1970s, international stocks significantly outperformed the US. In the late 1980s, global markets, particularly the booming Japanese economy, surged while US growth was relatively slow. And then there's the decade that most people forget when they make this argument, the 2000s. The S&P 500 delivered a negative return from 2000 through 2009. If your entire retirement was in US large-cap stocks, you finished that decade with less money than you started with. Internationally diversified portfolios at least kept investors afloat through those 10 years. Market leadership doesn't move in straight lines. It rotates in long cycles that are hard to see coming and nearly impossible to time from the inside. By the time the consensus agrees on which market is winning, the rotation has often already started. By 2025 and 2026, you can already see early signs of international markets gaining momentum as investors start questioning the valuations of domestic tech giants. Nobody knows if that continues. That's exactly the point. I don't hold international stocks because I expect them to beat the US next year. I hold them because I'm not confident enough in any 15-year prediction to concentrate my entire retirement in one country's market. A target date fund just accepts that uncertainty without making a directional bet. But even if you're sold on the allocation, there's a mechanical problem that trips up most DIY investors, and it's one I underestimated for a long time. Imagine you build an 80-20 portfolio yourself. 80% stocks, 20% bonds. You have a strong year. US tech runs up 30%, your bonds stay flat. Without touching anything, your portfolio has quietly drifted to 85% stocks and 15% bonds. You're now carrying more risk than you originally intended. To fix it, you have to sell some of your winning stocks and move that money into bonds. That's rebalancing. It sounds straightforward until you're actually sitting there watching tech climb, and you have to consciously decide to sell some of it. Most people can't bring themselves to do it. They get attached to the positions that are working. They tell themselves they'll rebalance after one more good quarter. If it's a taxable account, they start worrying about the capital gains tax they'd owe, which gives them a convenient excuse to wait. So the portfolio drifts further from where it started, and they let it keep going. Inside a target date fund, this gets handled automatically. Vanguard's managers monitor the fund's allocation and rebalance using incoming cash flows or internal trades. Nobody hesitates. Nobody decides the timing is wrong. It just happens. Inside a Roth IRA or 401k, there's no tax consequence to any of it either. The rebalancing happens constantly without triggering a single taxable event. What this means in practice: during a crash, the fund is buying cheaper stocks. During a sustained run-up, it's quietly trimming gains into bonds. You get the discipline of buying low and selling high without ever having to summon the willpower to do it yourself at a stressful moment. The fund is emotionally indifferent to what the market is doing. You, holding it, get to benefit from that indifference. There's a study that comes out every year from a research firm called Dalbar that I think about more than almost anything else in personal finance. Every year they look at what the average mutual fund investor actually earned compared to what the funds themselves returned. And every year, without fail, the average investor earns significantly less than the fund they were invested in, not because they chose bad funds, because of when they got in and out of them. When markets are rising, people feel good. They add money, sometimes shift into riskier funds that have been running hot. When markets fall hard, something changes. A 20% drop feels manageable. A 30% drop feels uncomfortable. A 40% drop starts to feel like the rules have changed, like maybe this time is different. like maybe you should move to cash and wait until things stabilize. And so people sell, and then the market recovers without them. The gap between what a fund returns and what its average investor actually earns is entirely explained by that pattern. It's not a knowledge problem. Most of those investors knew intellectually that they should stay invested, they just couldn't emotionally when it mattered. A target date fund doesn't fix human nature, but it changes the conditions enough to matter. Because the fund is genuinely boring, there's nothing to pay attention to. There are no headlines about the Vanguard 2055 fund. There are no viral moments when it's performing unusually well or unusually badly. It doesn't have a personality, it just quietly does what it does. You stop checking daily, you stop comparing your performance to coworkers who claim to be up 40% on a concentrated tech position. You stop watching videos at 11:30 at night that make you feel like your allocation is wrong. The fund slowly becomes like your water bill, something you set up and then forget exists. And when you stop actively thinking about your portfolio, you stop having opportunities to make a decision that costs you 5 years of gains. The last piece, and the one that matters more the older you get, is what the fund does automatically as you approach retirement. When you're 30 years out, the portfolio is aggressive, roughly 90% stocks, 10% bonds. That makes sense. If the market crashes, you have decades to recover. You want growth. But as you get closer to retirement, the math changes. A 40% market drop at 25 is a bad year and a decent buying opportunity. The same drop at 58, 5 years before you plan to stop working, is a potential crisis. You might have to sell stocks at the bottom just to cover living expenses. You might have to push your retirement back by years. That specific risk, the market falling right at the moment you start depending on it, is what keeps a lot of people up at night as they get closer to the finish line. The solution is to shift gradually toward more conservative investments as you age. More bonds, less stock exposure. But the question nobody has a clean answer to is when to start and how fast to move. Do you start at 45? 50? How much do you shift each year? 1%? 2%? What if the stock market is in the middle of a crash the year you plan to start the transition? Do you lock in the losses to de-risk, or do you wait and hope for a recovery? A target date fund has a preset schedule for all of this, called the glide path. Starting about 25 years before your target retirement year, the fund begins very slowly shifting, a fraction of a percent at a time, from stocks toward bonds. By the time you reach retirement, the portfolio has moved to roughly 50% stocks and 50% bonds and short-term income assets. The whole process happens gradually enough that you're never making a dramatic shift all at once, and it keeps moving whether the market is up or down that year. You don't have to decide when to start. You don't have to pick the percentage. You don't have to worry about whether you're making the transition at a bad time because the market already dropped and you don't want to lock in the loss. The schedule was set when you picked the fund. Could I build all of this myself? Yes. The holdings of any Vanguard Target Retirement Fund are public. You can write down the 4 funds, write down the percentages, and replicate the portfolio with individual ETFs. You'll save that 0.04% a year. You'll also get to customize, hold less international if that bothers you, adjust your bond percentage, design your own glide path timeline. For some people, that's genuinely the right call. If you enjoy the process, if you have the discipline to rebalance on a schedule without second-guessing it, and if market headlines don't tempt you to make adjustments, building it yourself makes sense. But for me, the flexibility was the problem, not the solution. Having the ability to adjust my international allocation meant I was always wondering if I had it set correctly. Having control over the glide path meant I was always reading about when other people recommended starting. The customization didn't make me more confident, it gave me more things to be uncertain about. If I can change something, I will think about changing it. Remove that option and I stop thinking about it. By holding a target date fund, I've voluntarily locked myself out of the decision, which sounds strange until you've watched yourself make enough bad decisions under pressure to appreciate the value of not having the option. The time I was spending on all of this, checking allocations, researching factor tilts, watching videos about whether my international exposure was a drag, that was time not spent on things that actually move the needle on retirement savings. Earning more money, advancing in a career, building a side income, generating a few extra $1,000 in income in a given year does more for a retirement account than shaving 0.04% off an expense ratio. That math is not even close. My investing philosophy has gotten simpler as I've gotten older, and I don't think that's a retreat. I think I've just gotten clearer about what I'm actually trying to do. I don't need to have the highest returning portfolio in any single year. I don't need to beat the person who went all in on US tech. I don't need to predict which country or sector leads the next decade, and I don't need to find the mathematically perfect allocation. I need a diversified portfolio, low costs, regular contributions, and enough confidence in the strategy that I'll still be holding it in 30 years. That's what the fund provides. Not a guarantee of the highest possible return. Not the cheapest option on the market, but a complete, globally diversified, automatically rebalancing, gradually de-risking portfolio that I will never be tempted to dismantle because something made me nervous in October. Will it underperform sometimes? Yes. In years when US large-cap tech is running, a 100% S&P 500 portfolio will look better. In years when bonds are flat, someone with no bonds will look better. That's fine. I'm not running against other investors. I'm running against my own worst tendencies, and for that, the simplest portfolio I'll actually stick with beats the optimal portfolio I'll tinker with every time. If you genuinely enjoy researching funds and managing your own allocation, a target date fund will feel too passive. There's nothing to do. It's designed to be boring. But if you'd rather spend your Saturdays on something other than wondering whether your international exposure is dragging you down, and if you want to know that your retirement is still on track even during the years when you're not paying attention, that boredom is the whole feature, not a flaw. A lot of people spend decades building the account and almost no time thinking about what it took to stay invested through the hard years. The portfolio that got them there wasn't always the most sophisticated one. It was usually the one they could hold without flinching. Thanks for watching. I'll see you in the next one.